Hi, I am Pramod Kumar, the Chief Investment Officer of 361 Portfolio Managers. I'm here to talk about the one question that everybody asks: what is factor-based investing? Factor investing is an investment strategy that involves choosing assets based on a certain set of factors or attributes. It differs from traditional diversified investing by focusing on specific fundamental and price characteristics of the individual securities. Factor investment strategy selects investments by filtering for predetermined factors. The most common predetermined factors are size, value, growth, quality, momentum, and low volatility. A brief elaboration of what some of the factors are will give a better understanding of what the factor-based approach is. Quality would be companies with predictable earnings, consistent profit margins, high return on capital employed, etc. Growth companies would be those with consistent increase in sales, earnings, cash flows, etc. Size as a factor is investing by the size of the business, investing only in, for instance, in large companies which are market leaders, or only in businesses which are emerging and smaller in size. Value strategy would be investing in companies that are cheap relative to their intrinsic value. Momentum, where strong recent price performance or earnings growth would determine the investments. Low volatility is when investing in stocks which exhibit lower volatility in price movements relative to the broad market. These are not a complete list of factor-based strategies, but are some of the most commonly used. A factor-based strategy is chosen as an investment approach when the investor has the conviction that a particular factor will help achieve the desired outcome. For example, value, a long-use factor approach, would be where an investor who has a value bias builds a portfolio by investing in stocks which are trading below their intrinsic value. Another way factor strategy is widely used is to add a single factor or a few factor-based strategies to a traditionally diversified portfolio. The objective is to create a bias towards a particular factor depending on the market or economic environment. An instance would be adding a momentum factor-based index fund to a diversified long-term portfolio when the investor feels that for a period the market conditions are ripe for momentum to do well. Another common approach is to build a diversified portfolio of factors through active managers or passive funds. A portfolio with exposure to value, growth, size, quality funds would be an example. Factor approach has its challenges in practice and is typically used by investors who have arrived at a certain level of deep conviction after disciplined analysis. A key challenge in factor investing is predicting when a particular factor will perform. A testament to this is the long period of underperformance that value investors had to endure during the last 2 decades when other factors did very well. While the result of investing in a particular factor may very well be beneficial, the journey to the outcome is unlikely to be linear and could be more volatile than a traditional diversified strategies. Investors will also have to be aware that there is no single definition of factors, and like all investment approach, defining factors is both an art and a science which evolves over time. Factor-based investment strategies have a role to play in enhancing returns and improving risk management, but need to be used in a deliberate and nuanced manner. Investors and fund managers with a long-term orientation have successfully used factor-based strategies to achieve their portfolio goals.